Good afternoon, and thank you for joining us for our webinar focused on the Purdue University CME Group Ag Economy Barometer. I'm Jim Mintert, Professor of Ag Economics and Director of the Center for Commercial Agriculture here at Purdue. And joining me today is my colleague, Dr. Michael Langemeyer, who's also Professor of Ag Economics and the Associate Director of the Center for Commercial Agriculture. Michael, it's interesting to talk about the barometer. Maybe we should start off by just giving a little overview of how we put the barometer together. We survey 400 farmers nationwide every month, focused on farmers that have a gross revenue in their operation of over $500,000. And that group of people produces about 2/3 to 70% of the nation's food. So it covers certainly the majority of farmers around the nation, and covers the major enterprises that they're engaged in as well, right?
Yeah, and approximately 50% are corn and soybean, because that would be consistent with the census, and so that would be a very large group of people would be corn soybean producers.
And then we also cover livestock. I think, for example, 19% of the survey respondents every month have a beef cattle enterprise, and so on down the line. Of course, those details about how the survey is put together are available on our Ag Economy Barometer website. If you need some more information about the background, how we put the survey together, how we calculate the index, etc., all that information is available on the website. So with that, let's kick it off and start looking at the results from this month. And here's the Ag Economy Barometer, which is our overall measure of sentiment regarding the economic health of the ag economy from farmers. And as you look at it, Michael, we topped out back in July with an index reading of 112. We've sort of been on a downward path since then. We had a little bit of a bounce a month or so ago, but this month's reading was 92, down significantly compared not only to last month, but especially when you compare it back to the summer. And I think really a couple of things driving that, but obviously the decline in prices that have taken place over the course of the summer has been a big factor in terms of driving the barometer lower. It's interesting, I think, though, to dig a little bit under the hood of the barometer, and that's what we really like to do. And we can decompose the barometer into two sub-indexes. One is known as the index of current conditions, and the other is the index of future expectations. And when you look at this, Michael, you can really see some differences there, right?
Oh, definitely. You can see a rather large decline in the index of future expectations, and that's really driving the downward trend in the entire Ag Economy Barometer is what's going on there with respect to future expectations.
Yeah, because you look at it, the index of current conditions actually rose a little bit this month, and actually 2 months in a row we've seen a little bit of a bounce in the current conditions. And if you think about what's taken place there, I think if you think about when we surveyed people this time, it was the third week of October. Many people, particularly the corn and soybean producers, were in the midst of harvest. And in many locations around the nation, that was really an environment where they were harvesting either record or near record yields, at least in many locations. And that probably provided some of that optimism about current conditions. We also had a little bit of a bounce in commodity prices taking place about that time. So those two factors came together and maybe gave us some of that optimism about the current conditions. But boy, that really a decline that's taken place now over several months with respect to people's perspective about 12 months from now and even looking farther down the road.
Yeah, and you look ahead. To next year. Look at December 2017 futures price. That's well below $4, and so you look at that, and then margins are tight this fall despite the high yields. You start thinking about what would happen to margins if we have trend yield, which we haven't had for the last couple of years across the Corn Belt, and so I can see why there's a little bit of pessimism when they start looking forward.
Yeah, so we got a little bit of a respite with the bump in yields and maybe the bump in prices this fall, but the long-term concerns about the ag economy are still there. One of the questions we ask is, would you say that your farmer operation today is financially better off, worse off, or about the same compared to a year ago? And I've got the results on the screen going all the way back to when we first started collecting data for the Ag Economy Barometer back in October of 15. And you can see a slight uptick there, kind of a little bit of an uptrend in terms of people reporting that their operation is actually a little bit worse off compared to a year ago. But if you look at the last two observations, I think it's consistent with what we just saw. People are a little more optimistic about the current situation because of those yields and perhaps because of the bounce in prices we saw recently. that probably explains a lot of what's going on with respect to that index of current conditions.
Yeah, definitely. But another thing to look at here, Jim, is how consistent this is. We started this barometer a year ago, and it has never been below 60%. They didn't think it was worse than the year before, and so certainly the tight margins are here for a while.
Yeah, we've coming off a period of a number of years of very positive returns in the ag sector, and now we're in a significant longer-term downtrend, and our results kind of reflect that. Take a look at this one.
This
Michael.
one here is really interesting because we've seen a large spike in the percent of people that think that their operation is going to be worse off than it has been recently, and so going from 33% in August all the way up to 42% in October, and so just a very large spike there in the percentage of people that think their operation is going to be worse off.
And if you think about crop producers again, I think probably what's going on there is very much what you just said a minute ago, which is this idea of, okay, things aren't quite so bad here in the fall of 16 because we've had a little bounce in prices, and I'm looking at either record or near record yields. But if a year from now, if we see prices realized that are currently predicted by the futures market combined with average or trend line yields or even below trend line yields, clearly that would put crop producers in a very difficult situation, and that's weighing very heavily on their minds. This is interesting.
Yes, it is.
So for the first time, we asked people over the next 5 years, are widespread good times or bad times more likely? And we've broken it out in crops versus livestock. And consistently since we started collecting data, people have been more optimistic about the livestock side than the crop side, but not this month. We've really kind of crossed kind of a Waterloo moment almost, Michael, with respect to that change, and I think reflective of what's taken place in livestock here in 16.
Oh, definitely. Swine prices are lower and expected to be relatively low for a while. Calf prices are lower and expected to be lower for quite some time. Large losses in finishing swine and finishing cattle right now, and so that's not optimistic. And milk prices are relatively low, very low compared to what they were 2-3 years ago. And so all of the industries that are represented by the people we're surveying here are seeing much tougher times. And so we don't do a lot of predicting here, but if I had to predict, this is probably going to stay this way for a while. I think the livestock producers are facing quite a bit of financial stress right now, even compared to the crop producers.
And one of the things that took place, especially in the beef cattle side, Michael, was expansion showed up more quickly than the industry was expecting. Lower prices more quickly. I think the industry had an expectation that we ultimately would see some lower prices in response to increasing supplies, but the supplies showed up at least a year earlier than anybody was really expecting. So we've really changed the situation very dramatically. It went from just a couple of years ago, the most positive returns we've ever had in the cow-calf sector, and now we've eroded that pretty dramatically here. And so it's a big change in a very short span of time, and I think influencing some of our other results as well.
And lower feed costs helps, but it's certainly not a panacea by any stretch.
Yeah, it didn't help enough.
No.
It was not able to compensate for the dramatic decline in calf prices, feeder cattle prices, and as you pointed out, fed cattle prices. Let's take a look at the chart. I've mentioned a couple of times the bounce that we've seen in commodity prices, and as you look at the chart, keep in mind that we were collecting data this month, the third week of October, and you could see that the bounce in corn prices got underway a little bit before that, but clearly we've seen some improvement with those corn prices bottoming out late August, early September, around 340. This is looking at the July futures contract. We topped out at about 380 or a little better. So that was a pretty big change. 40-cent move in corn prices, that's enough to make a difference. It maybe didn't drive things up to people's break-even levels, Michael, but certainly
much
helped.
Closer than we were before.
Yeah, it made a big difference on returns. And you look at soybeans, we saw a little bit of a similar situation with soybean prices. Really bottomed out there at the beginning of August, but kind of retested those lows in late August, early September. And then since then, we've seen a nice improvement. The last few days has been a little bit of a downturn, but nevertheless pushed those soybean prices past $10. And that's kind of a significant number because one of the questions we asked people on this month's survey was what they thought about the likelihood of prices breaking through the $10 mark for those July
For
futures
soybeans
contracts.
and $4 for corn.
Yeah. So let's take a look at those.
And we use that $4 and $10 for a couple different reasons. One is that's similar to what the corn-soybean price ratio has been historically, maybe a little higher, but it's similar to what the corn-soybean ratio has been historically. But also, if you look at high productivity ground, that's where the break-even lies. The approximate break-even lies for people that are producing on high productivity ground, right around that $4 corn price and $10 soybean price. And so that's why we pick those benchmarks.
So let's take a look at those results, and we've got several different things plotted here on the chart. So we've got the percentage of people that said they expect July corn futures to exceed $4 a bushel. That was 34%. People that thought corn prices were going to drop or could drop below $3 a bushel. Again, looking at July futures, 27% of the farmers responding said that. On the soybean side, 30% expected it to break through $10, and actually it was breaking through $10 while we were doing the survey. And then on the soybean side, 25% of them said that they thought soybeans could trade below $8 a bushel between now and next summer.
And I think you were a little surprised at the negativity here with the percentage of people below $3 for corn and $8 for soybeans. I certainly was. I knew there would be a certain percent there, but I didn't think it would be a quarter of the people we surveyed.
Well, if you go back and think about our index of future expectations and think about how negative it was in terms of its direction or trend relative to the index of current conditions, this chart probably explains a lot of that.
Yeah, it's certainly consistent with it.
Because people that have a very negative viewpoint about commodity prices are in fact those that have that very negative view about the future, and that's really the concern. We ask that same question quarterly. We survey thought leaders, and the thought leaders, let's drop back for a second and talk about that. The thought leaders are comprised of people in the ag input supply industry, agricultural lenders, academics, some government people, people that are, for example, in leadership positions in some of the commodity organizations. And we survey 100 thought leaders quarterly. So we ask them the exact same question. And I want to draw your attention to the negative part of this, which is the percentage of thought leaders that thought corn would trade below, July corn of 17 would trade below $3 a bushel between now and next summer. 13% of the thought leaders, it was 27% of the producers that thought that would happen. And on the soybean side, the thought leaders, I think 18% versus I think 25% on the producer side. And so really a contrast there. There's a group of people, a group of producers that have a pretty negative outlook with respect to where commodity prices are headed. On the thought leader side, a much smaller percentage of the thought leaders thought that was likely. And I think that's kind of interesting as you think about it going forward. That kind of explains some differences there in terms of longer term perspective. The thought leaders are a little more optimistic about the future than some of the farmers are. And I think that commodity price outlook probably explains quite a bit of that.
And that was a little surprising to me too, because usually it's the reverse. The thought leaders tend to be a little more pessimistic on questions like this than the producers. But certainly this month it was the producers that were more negative, more pessimistic.
Yeah, that's a good point. When we ask questions about, for example, land prices, the thought leaders consistently have been more negative about the direction that land prices are going to take than the producers. So you're right, that is a little bit of a distinction and a little bit unusual. Michael, we asked some questions about management changes. I'll let you talk about this for a second.
Yeah, we asked several questions related to management changes. One of them with respect to lower fertilizer rates. Now, we didn't distinguish between nitrogen, phosphorus, and potassium, so keep that in mind. We asked a question, are you likely to lower your fertilizer rates? And 46% said yes. Now, we didn't ask for magnitude either, so that could be relatively small changes. We don't really know that. Contrast that with the percentage that indicated they were going to lower seeding rates, approximately 20%, and then those that were going to adjust seed hybrid or variety trait package was 35%.
Yeah, and so there's some reasons why we ask these questions, and let's focus on a couple of them. If you look at, for example, land-grant university research, particularly on the soybean side, I think soybean specialists around the Corn Belt are advocating that farmers look at reducing seeding rates actually to optimize yields and actually reduce their production cost on a per bushel basis. So that was one reason we asked that question. On the seed, the hybrid variety kind of trait package, a lot of discussion in the industry about producers backing away from, for example, the triple stack hybrids packages that have been popular in recent years as a means to try and reduce their production cost, looking for situations where maybe those packages weren't necessarily needed. And so that's interesting to see 35%, a little over a third of the people in our survey indicated that they were going to make a change there.
Yeah, these percentages are actually higher than I thought they would be for all three of these items.
Yeah, the fertilizer rates is maybe a little tougher to interpret. You know, we were talking about it before the webinar today, and although we didn't ask a question follow-up relative to which nutrients people were looking at reducing or how much they were reducing those rates or thinking about reducing those rates, we think that that's probably focused most heavily on phosphorus and potash, and probably a little less so on reducing rates for nitrogen, in part because in many situations people might be able to reduce their at least 1 year application rate on phosphorus and potash and perhaps not have a significant or noticeable impact on yield. Whereas nitrogen, you think about that on corn or wheat or perhaps some other crops, clearly that tends to give you a 1 year yield effect, and so people are probably a little more reluctant to reduce those N rates. But very interesting that people are obviously looking at, I would argue, most, if not every aspect of their operation, looking for ways to reduce cost in an expectation that they're going to have to find ways to deal with this lower price environment as opposed to just waiting for prices to recover. So very interesting. We asked the same related set of questions to producers, and I'll let you talk about that for a second, Michael.
We also asked them, what are your expected source of change to substantially improve your farm's financial situation? So that was kind of the question we asked, and we said, these are separate questions. Is it going to be due to higher grain or livestock prices? Do you expect those to substantially improve your farm's financial situation? Do you expect some lowering of variable expenses to improve your financial situation? Or do you expect lower fixed costs? Now, on the fixed cost question, it was specifically worded to include farmland, equipment, machinery and equipment, or capital items, and family living. And so it's pretty important to note that those three items were specifically listed. For lower variable expenses, we didn't list all the variable expenses, but we did note seed, fertilizer, and pesticide. And so just to give you a little bit of context on how those questions were asked. Again, Jim, I was a little surprised at that the higher grain prices was actually a higher percent than the other two.
Yeah, if you go back, though, to our previous results, there was a group of people, and we've kind of got a little bit of a bimodal distribution going on here. There's a group of producers that are relatively optimistic, it appears, with respect to seeing a rebound in commodity prices. And there's another group of producers that have a very negative outlook with respect to where commodity prices are going. And I think when you think about it in that context, the 25% that said they expected higher grain or livestock prices to help improve their financial situation, that's reflective of the group that has a little more optimistic view about where prices are headed here the next year or so.
And it's probably really correlated with the group that expect corn price to be above $4 and soybeans above $10.
Yeah, very much so.
Yeah.
The variable expense side is, of course, what we've spent a lot of time talking about, and also on the fixed expense side, we've been advocating that people think about ways to make some changes in their operations. So if I had an expectation for that coming in, and maybe it was to see a little higher percentage than what we saw there. We asked that same question to the thought leaders, and the contrast between what we just saw from producers and the thought leaders is actually quite interesting.
Yeah, it's remarkable. I mean, this is kind of the way I expected the results to turn out. Very low percent thinking that higher grain prices are going to improve our financial situation, and so really getting some help from lowering variable expenses and lowering fixed costs. And three cost items that we've been talking about quite a bit are seed, fertilizer, and cash rent. Seed and fertilizer would be in the lower variable expense column there, and cash rent would be in that lower fixed expense column.
And, we'll talk about this more a little later, but we have seen some evidence of some of those variable expenses coming down. Some of it because of changes in prices in those variable expenses, and some of it, as we indicated in the previous slide, people thinking about making some management changes.
Yeah, that's a good point. Fertilizer prices have came down, dramatically in the last year, and so this question is: are they going to continue to go down? And people might think they're not going to.
Yeah, the other thing that's interesting about this with the thought leaders is some of the thought leaders obviously are engaged in the input supply industry, and that might reflect some of the feedback that they're getting and maybe some of the pushback that they're getting from perhaps some of their customers. There's going to be some interesting negotiations probably take place on the input supply side this winter and into the spring, and so I think that could also be reflective of that.
Yeah, and we were talking earlier this morning about lower fixed costs. It's rather difficult, at least in the short term, substantially lower those, because let's talk about what those are again. Cash rent, small adjustments are probably going to happen here in the next year, but are they going to be substantial? Not necessarily. Family living expense, yeah, there's going to be adjustments over time to family living expense because they increased rather dramatically from approximately early 2000s up to about 2014, 2015. So there's probably going to be some adjustment there, but it's not going to be very quickly. And the capital expenses, even if you don't buy any equipment, you still have the equipment you purchased in the last 10 years, and those expenses are still there, and so it's really difficult to reduce those fixed expenses.
Yeah, in the short run, it's very difficult, and so a lot of that help's going to have to come out of that variable column, we think. You've taken a closer look at this using the budgets here at Purdue, and so I'll let you walk through that.
Yeah, this is from the Purdue budgets, and what I've got here is for the larger costs on a per bushel and a per acre basis, and we've gotten a lot of help from fertilizer. If you contrast 2012 to 2017, just a remarkable decline in fertilizer prices, and so we've gotten a lot of help from fertilizer prices. Seed has backed off a little bit, so a little bit of help from seed here in the last couple years, but not very much. Pesticides has probably went the other way. It's not that the prices have increased so much, it's the fact that we're facing weed issues, particularly with soybeans. This is a corn chart, of course, but particularly with soybeans, and so pesticide costs in quite a few instances are actually increasing on a per cost or per bushel basis because of that. Also on here I've got cash rent. In Indiana, cash rent peaked in 2014 using the Purdue Land Value Survey, and it's declined since then. We're expecting a 5% decline in 2017, so continue some moderation there in cash rent per bushel.
So, Michael, is there a chance we could see cash rent come down more than that 5%? Because I think on last year's survey it did come down a little more rapidly than that. We were a little bit surprised by that.
I usually say 5 to 10%. I think 5% is probably more likely. I think one of the reasons why cash rent came down harder last year, 2015 to 2016, is the northern half of Indiana had some pretty tough weather situation, and I think that really did impact the averages for the state. And so I personally think we'll be closer to that 5%, but no, there's probably 5 to 10% that needs to come out of cash rent if we don't lower other costs.
Yeah.
You get those break evens down. As we move into 2002, 2018, 2019, as we've indicated before, we probably need to take another 5 to 10% out of cash rent.
And you've done some research on cash rent response to changes in returns in corn and beans going back the last 50 years or so. And I think what you've learned is that we do see responses, but it takes a while.
Yes.
Right?
It takes several years in a row of low crop returns. They don't respond very fast. In fact, it's like 10%. They only about 10% cash rent. The coefficient, if you look at cash rent and net crop returns, is only like 10%. So crop returns are jumping all over the place, and it's important to cash rent, but they don't adjust near as fast. 10% as fast as crop net returns, and that's essentially what's happened here in the last couple years. The next 2-3 years, we're looking at about 4 or 5 years of low crop returns, and that's why cash rents are coming down pretty hard.
And I think it's important to point out that was true on the upside as well. They don't adjust immediately on the upside, but they don't adjust immediately on the downside.
One of the ways to look at that, and I recently wrote a piece for Farm Dog Daily that compared crop share leases and fixed cash rent leases. I think it's coming out tomorrow, in fact, and that clearly showed that if you were a crop share landowner, your returns went up very quickly in response to the high prices that we saw after 2007. But also, if you were a crop share lease landlord, your rents went down very fast in 2014. Cash rents just don't adjust like that.
Right.
They're sticky on the way up and they're sticky on the way down.
So one last point, we mentioned this earlier, but it's useful maybe just to look at how much those fertilizer prices have changed. Michael, you've pulled this together.
Yeah,
from some
here I'm
USDA
looking at
information.
late October 2015 and the most recent report from Illinois Production Cost Report, USDA NASS, and you can see there nitrogen down about 25%, phosphorus down about 20%, and potash down about 28%. So very large decline in fertilizer prices, and that's just verifying what I was showing earlier in the chart, that we've taken quite a bit of cost per acre and cost per bushel out of fertilizer prices in the last 3 to 5 years.
Looking ahead, more declines likely?
I think there's a possibility for some small declines because prices aren't real strong right now, and I think that does that is an important ingredient when you're looking at fertilizer prices. But I don't expect these drops to continue.
Yeah, good point.
During the next year.
Well, with that, I think we'll wrap up our webinar today. Thanks for joining us for the Purdue University CME Group Ag Economy Barometer webinar. And of course, thanks for your interest in the barometer. We'll be releasing another report. We release the barometer on the first Tuesday of every month, and so the report goes live on the website. And if you've got questions, obviously email us and we'd be happy to respond. So thanks for joining us. Our next webinar will be, actually we have a Center for Commercial Agriculture webinar coming up on the 18th of November, focused on some farm policy issues. And of course, we'll be having other webinars during the course of the year. Keep an eye on the Center for Commercial Agriculture website. Our next webinar for the Ag Economy Barometer, I think, comes up in after the first of the year. So we hope to see you on that day. So thanks for joining us and have a good day.